Right, good evening, ladies and gentlemen. Very warm welcome to, I think this is our fourth virtual and live event that we are going to have tonight. And it's our fourth one that we actually discussing the distressed property market. But we've really tried to unpack it and to find out, where are those opportunities in that particular market in the context of the bigger property market. And I must say, I'm really excited from the discussions that we've had. We've seen from the registrations from tonight, we've got a fantastic online audience. So thank you all for joining us. It's wonderful actually having you there. For those of you who don't know me, my name is Neil Peterson. I'm the founder of Real Estate Investor Magazine and also the content platform rei.co.za. We also do a number of events and webinars every week, and we really get in depth about property investment. So hopefully tonight you're going to learn a lot, and we encourage you to also engage, to ask lots of questions. And I'm not the expert here tonight. I've got a wonderful panel next to me. And so on my left-hand side, and probably from on the right-hand side next to me, first of all, we're going to ask each of the panelists. And I must say that tonight's event is all thanks to the Wealth Assist Group. And the first person I want to introduce is Daniel Lombard, who is the CEO of the Assist Group. So Daniel, do you want to introduce yourself to the audience first and just tell them who you are, what you do, and greet our audience both online and of course our wonderful live audience here tonight.
Thank you, guys. Thank you for your time.
Your microphone.
Thank you for your time. Appreciate that you have come and invested some of your time here tonight. I know for a fact you will walk out here substantially richer than you were when you're entering, and you guys online as well. Not purely with what you're going to hear, but in lots of it's going to be very practical. We have got a bit of a jam-packed evening tonight, so thank you very much. It's my privilege to be on the panel, and we'll share it with some of the great guys here tonight who will help you to inspire you into real estate investment, how to do it right, and make sure that you actually make profit on the end of the day, because I think that's part of the outcome that you all want to see.
Great, wonderful. Great having you again, Daniel. And our next guest is Miguel Martins, and Miguel decided to cross the divide and become a full-time entrepreneur in property. He has been an investor for a number of years, ex-banker. So we've got a banker and an investor. Welcome to you, Miguel. It's wonderful having you. Do you want to maybe introduce yourself in full to the audience, and both online and obviously our live audience here tonight?
Thanks, Neil. Very good to be here. It's always great to have these opportunities to share experiences, insights, thoughts with fellow investors. I have the privilege of having spent 25 years in banking.
Wow.
At Absa Bank. That's why I still have the T-shirt. And in the last 7 years in home loans, and in home loans I looked after the investor portfolio. So as a property investor myself, it was the perfect job, because I was spending time with people who did what I was passionate about. So looking forward to sharing some thoughts around that and where the market's going and how that affects us tonight.
Fantastic. Great having you here, Miguel. I mean, I can see you're showing your colors. You haven't left it behind. The bank in red. Okay, and obviously our next guest is Gerard from the Westhuizen. Gerard, do you want to just introduce yourself and tell them what you do and to our audience over here tonight?
Thank you very much, Neil. My name is Gerard van der Westhuizen. I must say I'm here because I believe in direct real estate investment, and to be honest, to do it the right way, because I've seen so many people that are actually in trouble, and I hope that we can assist you tonight to see how to stay out of trouble and what to avoid when you start investing in property for the long term. So I'm glad to be here. My role is to assist every client with the investment portfolio in property, and we hope that we can assist you as well. Thank you very much for joining us.
Great. Thanks very much, Gerard. And I think we're going to get straight into it, straight from here. And I'm going to ask you, Daniel, because we're going through it's been a tough year in real estate for a lot of people. And with our banker over here, they will always, the measure of the success of is looking at your distressed book and, how many months you're behind and that kind of stuff. But before you get into that, because I know you're going to describe the distressed market. I mean, you've got like 35 years plus experience, Daniel. So you understand the markets. You've both invested, you've been on both sides of the transaction, so you understand this inherently. But before you tell us about the distressed market, just tell us what Wealth Assist does, just so that we can see where you fit in and who does what, because I think that's very important for the audience out there to put that out there from the get-go.
So if we look at what's on the screen at the moment, you'll basically see the model of the Assist Group, basically comprising of two sides of things. So the first one is that if you look at the right-hand side, you'll see it talking about assisting real estate owners. Now, when we get to the stats, you guys will see what actually the number of people that's in distress and in need on the end of the day to need to be assisted. But at the same time, we all know what we require for that, and that is funding. So the real estate assist side is purely focused on actually assisting real estate owners who needs assistance, not losing their homes, try to keep their homes in the process, and if they can't, that they can actually walk out there with some proceeds and make the right decision early enough to actually do those type of things. So that's the focus of the real estate assist side of things. Obviously, you as the real estate investors here tonight have got the privilege to be important on the other side, and that is making an impact real estate investment. I know you don't know that term so well, but it is actually not misusing people's misfortune when they are in trouble, but actually doing real estate investments, making impact socially and financially in those people's lives while making excellent returns. And I think that's the combination of the two that working together, and the bottom line is that it becomes a win-win for all. And I think if we look at the stats and the things that follow year after, I think that will give you a good idea of how big the need is and what the opportunity is that it creates for you.
So it's not just by chance that you're sitting here in a medical building here next to an ICU. You're actually here for a reason. So somebody gets distressed, you resuscitate them, you put them back on the go. So it probably makes sense. You're in the right place.
we actually, when we moved in here, it was we call ourselves the ER of the property industry, and it's exactly that.
Absolutely. Tell us a little bit more about the distressed market. So what's actually going on there? Because let's just unpack it a little bit. And some people will probably look at this and they're thinking, well, why are people investing in property? There's so many distressed people, out there. So maybe just unpack that a little bit, and we can debate all those reasons and everything a bit later, and just lay it on the table just to say, well, what is the scenario? And then we can start exploring the opportunities and having a great round table discussion.
Yeah, so if you look at the slide that you got there at the bottom on the left-hand side, where it says 71 billion rands worth of mortgages, currently that is 60 days or more in arrears. Okay, that is 101,000 families, homes, or properties that will be lost at some case if it continues where it currently are. So that alone should tell you we need substantially more investors to actually help even 2% of that, of those people. Okay. So is there a shortage of supply? Not at all. Okay. There's a huge, huge supply. We need a lot of money, not only in the private investment side, but also institutionally. Otherwise, we'll never reach most of those people. So I think that is a very good starting point. And for me, looking at just on the second, the one in the middle, the number of community schemes that there are, and they have a 5 billion rand levy arrears yearly, okay, at an average. So that gives you a very good idea of if you're normally in arrears with your levy and your municipal, then it's other financial challenges that's in the process as well. And that doesn't even touch on the 37% of all credit consumers in our country. That whoever wants to buy a house today, and they even earn a salary, they can't actually buy a home. Okay. Because of the fact that they own, that 37% of them can't qualify for a mortgage today. I think that on its own give a very good bigger picture of what is the current status in the property industry and even entering into the property industry. But I think the more scary at the moment is if you look at from 31 days, you'll see there it's 11 billion rands worth of mortgages that is 31 days to 60 days in arrears. If you see from 2021 till 2023, how it increased that to 19 billion from 11 billion. So over the last 2 years, you've seen how this is deteriorating. So that creates big issues. Interesting thing is in 60 to 90 days, we got less. But then after that is the real jump. When we look at 90 days and further, that means when the banks are actually taking action. Okay, that part goes from 4.5 million to 7.6 million, 42 million to 50. That's 10 billion rands worth of additional mortgages in 2 years that went in arrears. And we'll touch on that a bit later. And I think part of that reason is obviously low interest rates. Everybody jumped on the bandwagon. Everybody bought property hastily because everybody tells you to go and maximize all your mortgages, all those nice things, which is not always a good thing, And I think that's part of what we're doing tonight, is to review that. If we jump to the next slide, just looking at sales, you'll see there that we look at the 22% average, 22.8, call it 33% of every sale that's currently in the market is due to financial pressure, either downscaling or have to sell because they're going to lose their property. That is, and if you look at how many properties are in the market, guys, this is huge. It's a huge, huge challenge. Okay, the 7% which I spoke about, interest rate. If you look at the stats, we had an increase from 2% to 3.7% of the total number of properties that have borrowed money at 7% and have nearly doubled at 80%, nearly doubled, that have to now sell. So a lot of those sales, and I know that I remember those days, that when that happened, that some guys came out and said, be careful, the interest rate's going to go up again. And we all knew it's going to go. It's going to go up, okay? Because it was just an assistance from the government or the banks or whatever at that stage to actually help the people through the COVID period. So you were unwise if you went and you maxed. I mean, Gerald will spend a bit of time of actual cases so that you can understand that. So I think from that perspective, I think it's important. Now, what does that actually leave us with? If we go to the next slide, you'll see there the banks have got a challenge because they are sitting with all these arrears. Okay, so what do they actually do? They can help restructure, do everything within their rights. But when you become over indebted, they can't give you more money because that is a contravention of the National Credit Act. Okay, so they can't actually do that. All right. And then what is their next step? Leave the blue gap of opportunity out of this situation. Their next step is unfortunately sale and execution, which we all know they want to avoid. I deal with the banks. I know a lot of people have issues with the banks with these type of things, but they actually don't understand that the bank, they don't want to take further risk with this property. They have to exit. That's why they've got lots of programs to actually assist you beforehand. But if you don't use that, it gets to sale and execution. So that is where we have the choice now to participate. That's the great opportunity for everybody in that gap where the bank can't do something anymore until sale and execution. That's where we operate. Okay, that's actually what the real estate and wealth assist are doing from our side. Okay, so we jump in there and say this is an opportunity. Somebody needs to bring solutions there. Without this brings us to the choice, and that I think is important. What is the choice? Are we going to buy that house, keep it when the guy can't rent it anymore from you, and you keep it at a below market value? And I know lots of people train you to do those things to make money. There's better ways, guys, to do that. Okay? You know, there's many words for it. Karma, what you sow, you'll reap. You can call it what you want. Okay? There's better ways, and that is by participating, bringing solutions to problems at the same time, making good returns. And I think if you want to invest in sustainable business, it always needs to be a win-win for everybody. And I think that's important. So, and that's the heart of what Wealth Assist does in this case. They bring investors to the table to actually assist other people whilst making good returns and have good security during this term. Yeah, and I think just to end off on the next slide, this is typically our kind of products. You can't help everybody to keep their homes if they can't keep their home. You are actually advising people, soos hulle in die Afrikaans sê, van die wal af van die sloot. We don't do that. Okay, we're very honest with the client. If he can't recover, and we test them. I mean, our mortgage originators actually do a pre-qualification for those clients. We know what have to be done to fix their credit score, help them to keep their homes. We check if they can actually do that in the term. If they can't do that in the process, we will advise them what is the better route to go. If it is to sell your home, at that stage, downscale a bit. We'll help you. We'll stop the legal action and those type of things. Assist you through the process, making sure that property can get sold on. Maximize your proceeds, because sometimes you don't have the money, but there's only 100,000 that maintenance that brings a value of 500,000. So things like that is all part of these solutions which we talk about. And very important on all our products here, which we're talking about here, is everything is on the shelf, pre-vetted, risk mitigated property investment opportunities where you have to do very little from your side to participate in helping people in this case.
Great, wonderful. I think it's a great product, and I think the solution is what it's all about, because I think if you look in the United States and you look at a measure of an entrepreneur, you've got to have been bankrupt 3 or 4 times. Then you're a success and you can bounce back. In South Africa, it's a matter of, no, we're going to hold on to this, and we hold on, and then we get beaten by all the different creditors on various fronts. And then there's a million debt products, which I would say is not a good idea. And I'll just openly talk about that kind of thing. But what I'm really trying to tell the audience is a massive opportunity here. The market is starting to turn. And we're sitting on Tuesday, the MPC, okay, Monetary Policy Committee is sitting on Thursday. We're going to hear whether they're going to actually hold interest rates or they're going to increase interest rates. What do you say, Miguel? What's going to happen now? First of all, Miguel's an ex-banker. I'm not going to ask you to comment too much and unpack what Daniel has said now, because I want you to take us talk a little bit about the market now and why we're here, and possibly why it is turning, because I'm quite upbeat, and I've spoken to a lot of property developers, and there's a lot of investment going back into property. But whether you're sitting with this kind of stock, and you'll talk about those kind of returns later, this could be the time to buy, possibly. Now, you're also an investor. I'm going to put on, first of all, what do you want to wear first, your banker or your investor's hat? So,
For the start.
okay, for the start, you wear your banker's hat and tell us a little bit about.
So if you're not doing the numbers, they say bankers are about numbers, right? If you're not doing the numbers, you're also not an investor. If you're a serious investor, it's all about the numbers. It's also about understanding where the market's going, how that affects your investment. You don't invest in a product or an area because of the market. You invest because of that particular property and the fact that the numbers make sense in the property. But you also want to have a good idea where where the market's going, because that will ultimately affect your property. So yeah, we'll definitely wear both hats. Listen, I've already introduced myself, but maybe just to comment that I have been around for quite some time. I bought my first property about 24 years ago in sectional title. Since then, done multi-lets, done flips. I've had portfolios in sectional title. So I guess I understand the market quite well. I've got a current portfolio, rental portfolio, and I've recently branched out into Airbnb. And just really trying to, why Airbnb? Because of interest rates. Interest rates are such that I need to find a way to increase the earnings on my properties to maximize the earnings, because the underlying cost, the home loan payment was just getting quite heavy. And in quite a passive type of investment strategy, which property is, at least rental investment property, you do need to be entrepreneurial and try to solve these kind of problems when they arise. And in doing so, I've introduced myself to a whole new strategy, and that's kind of branching out in different ways as well. But I guess the lesson is just to keep ourselves ready and prepared and open to the opportunities that come along. Maybe the next slide, talking about interest rates. So, sure, so this takes us back to 2002. What you don't see to the very left there, you see 17%, you go, oh my goodness. About 4 years before that, we were sitting at 25%. So I'm not going to say we've been here, because as high as the current interest rates are, they've actually never been so low. It's not as high. It's the lowest peak we've had in the last 26 years. So it's painful right now, because it's come off the lowest low we've had in the last 25 years, if not longer, right? Where we were just pre-COVID was interest rates were sitting at 10%. I think they were at 10.25% before COVID was announced. Went into COVID, everyone just held their breaths on what the thing is going to be. And the Reserve Bank had to get involved and to stimulate the market. And what they did, as Reserve Banks did all over the world, is they reduced interest rates. In our case, prime reduced to 7%. And we got down there, we held our breath, and all of a sudden this market, the property market just took off. People who still had their jobs, still had salaries, could afford properties that they couldn't have afforded a year ago, a year before. So we had a really great run at 7%. And at 7%, I remember someone asking me, should we fix our rates? I think the right answer was yes, fix it now. We'll do a 5 year as long as you can fix, but if you had fixed rates then, you would have fixed them at about 8.5%. So why would you fix them at 1.5% more, when rates are so good? Well, that's because of what happened in 2022, right? And we saw that 7% creep up right to where we are today, 11.75%. It's happened around the world. The UK, I think they hit 6.5%, 7%. They've got a slightly different market, so where they're coming off 1%. The US very similar as well. And everyone was trying to curb the inflation that had been created by the low interest rates, right? Sorry, so I lost my train of thought there. So, and just talking about inflation. So, today, tomorrow, the latest inflation rate comes out. And as Neil said, the APC is sitting, the Reserve Bank sitting on Thursday, tomorrow and Thursday. And on Thursday afternoon, about 2:30, 3 o'clock, they put out their statement and they release whether they will be increasing interest rates or not. But the inflation figure that comes out tomorrow from Stats SA will very much influence that. Thankfully, the expectation is that, and I don't have the number right now, but we are very close to the medium point of where we want interest rate inflation to be, around the 4.5%, 4.8% mark, right? So at the moment, and if you speak to different economists and read the papers, the expectation is that rates will remain flat on Thursday. That's correct. They've remained flat for the last 3 MPC meetings. So effectively, we've hit our top to a large degree. And if you look at the rest of the world, the rest of the world's also already starting to price in reductions in interest rates in their economies. And South Africa will probably be expected to follow that. So just go back a slide. So where do we expect interest rates to go and when? Now it's not okay. If it's a ceiling, when are we going to go back to where we were? Well, we're never going to go back to 7%. At least not in the foreseeable future. That was an extraordinary event, as extraordinary as COVID was. What the Reserve Bank does expect us, where they do expect us to go, is by this time next year to be down by 0.75%, back down to 11%, and then the following year back down to 10.75. So call it a year and a half from now, we're back down by 1% to 10.75. Why not back down to 10%? That's a question I had for the AFC economist. Just the world has changed. We're in a very different structure. Interest rates across the developed world are now higher than they've ever been, and they won't go back down to where they were pre-COVID. So that just affects us, and the impact is that we will now be roughly 0.5% or 0.75% higher than we expected to be. They were before COVID. Having said that, this is all a forecast. It's all based on current inputs. When this was put together, there wasn't anything happening in the Middle East around Israel. Just like at 7%, Russia hadn't invaded Ukraine. So these things happen, the Middle East erupts, affects the price of oil and the rest, and that obviously has a trickle-down impact on us. So this is the best view we have at this point in time. It's a positive view, but where it does, and connecting to the previous conversation, these high interest rates have put a lot of homeowners at risk. Homeowners whose salaries haven't increased with interest rates, where out of the two earning at home, one is now out of work, etc. So people are in trouble. People do not get out of trouble because interest rates go down. They just continue being less in trouble, but they're still in trouble. And the expectation is that the number that Daniel shared on the index number that Daniel shared on the screen just now, that's going to increase even when interest rates drop off, because there's a lag factor. People hold on, they utilize their savings, they borrow from friends and family, and eventually, just all falls apart. We're still going to see the worst of it effectively come probably over the next year. So it sounds counterintuitive, but it's about what the lag effect of it coming through. We aren't in a strong economy. A lot needs to be fixed, and they don't recover as soon or as quickly as we'd like them to. So we're still going to see a lot of blood in the streets over the next year, 2024 into 2025. So maybe just a quick view on the next slide in terms of how the banks look at this. And Daniel, you touched on it, right? But I just wanted to talk to kind of what the timeline looks like. And this is a high-level view. It's quite indicative. But generally, once you miss your first home loan payment, you've got about 6 months. In those 6 months, your interest starts capitalizing, or you start getting calls from legal. But the bank really gives you about 6 months to figure it out. Either catch up with your payments, to restructure your loan. They might take, you've got 13 years left, and they extend it out to 30 years just to reduce the monthly payments to a more affordable payment. There are a variety of actions the bank will try and do for you to be able to hold on and make those loan payments. And also considering that 8 months from now, we should already see a bit of a reduction in interest rates, and just can we hold out until then? So that's the bank gives you for 6 months. Also in those 6 months, we have the various banks with their programs. ABSA have their Help You Sell program. Standard Bank have their Easy Sell program. FNB and the rest also have similar programs where they work with the estate agencies, the large brands, the attorneys, etc., to make it easier for you to sell. They might cut some of the commissions. The bank might put forward some funds just to enable homeowners to sell, because they really just want that to move with the book. The bank does not want to own properties, and actually the bank would like that homeowner to get out of the situation, which is not good for anyone. After 6 months, now all this time it's rolling, and your debt is compounding. You are getting calls from legal, but after 6 months, that absolutely intensifies. Now you're in the full-on legal process. There are still options to sell. The property is still the homeowner's, but now you're actually getting towards what we will consider as a repossession, etc. You're very much in that process, but that does take 12 to 18 months at least. There's a legal and court process that's got to be followed. At the end of the day, banks do not want to repossess your home. They don't want to own your home. That's not what they're there to do. They do need to collect on the outstanding debt flow. So in the worst case scenarios, and actually most of the time, the customer will sell their property or come up to some sort of arrangement before the ultimate action, which is to sell a fourth sale through the sheriff or other means. But that does take some time. But the emotional stress that the homeowner is under from that month 1, month 2. In the first few months, it's about hope. They hope that something will change, and a job will be found, a rich cousin will help them out of the hole. They live in that hope, and very often, actually more often than not, something does come through and they're able to get out of it. But now 6 to 12 months in it, and you can imagine if Home Loans is calling you, the Home Loans department, other departments are calling you as well, people arriving at your door. It's extremely stressful on the homeowner, on the family, and it's a really difficult situation. So I think what Daniel and the team are doing here to support that environment, to try and find a way out of it where there is an amicable outcome, I think is definitely something that's needed, especially at this time in our country.
Great, nicely put there, Miguel. I think you set the scene very nicely, and took us through a bit of a roller coaster ride over there. And certainly that's how interest rates have happened. I'm going to throw a bit of a clip in the boss over here, because I've actually interviewed Robert Kiyosaki 6 or 7 times, and he says your house is not an asset. Absolutely not an asset. And we actually seeing it in this particular scenario over here. And what I want to do is just demonstrate a point here. I mean, Miguel is now a seasoned investor. He's here in Cape Town, but he's got 6 properties, which he doesn't necessarily own by the back, which he's got a rent-to-rent kind of scenario. Am I allowed to disclose this? Is this well, I have already, haven't I? But what I'm really trying to demonstrate over there, that there's always a way to skin a cat. And when somebody hits into a sort of financial corner, and I think everybody at some stage in their life, whether you're an investor or whatever, gets to a stage where something goes wrong. And I mean, we all experienced COVID. That was very difficult for everybody. And then of course, prior to that, every 10 years we have some or other event. I mean, you mentioned the 25.5%. I remember very clearly it was July 1998. 25.5 was the super high. People running from the hills from the real estate. And then we had the dot-bomb crash. And then, of course, we had the big refinancing thing, and the South African property market in 2002 had a massive boom, 2002 to 2006, and everybody was bonded to the hilts. And along came the developers and hairdressers. And of course, everybody was bonded to the hilt, and we're talking about property. And of course, along came the global financial crisis just to bring everything down. And we've had so many different crises, we can actually go through all of it. But I'm coming to the question here to you, Gerard, because you talk about generational wealth and you offer solutions. And I like what Miguel said, it's all about the numbers. And if the numbers don't make sense, why are you buying? And but also we could say to the bank, well, you can stretch it a bit with this income and that income, and when we do the initial application, sometimes the banks say, oh, well, I think you just passed. But we're not pointing fingers at anybody here, because I think at the end of the day, we want to also be able to give people that opportunity to own an asset. So, Gerard, just take us through. I know you've got some case studies also to share with us, and how people are getting it wrong, how people can get it right, and how to build generational wealth. Do you want to maybe take us through those things?
I will.
Yeah.
Thank you, Neil. I've got so many slides. Just before you go to that one, I wanted to introduction. If you can go back, there's in economy circles. There's a thing called generational. It's actually called the poverty trap, and it can become generational. And I realize that some of the solutions that I see in the open market is that if families don't get together, friends don't get together, they will actually not be able to overcome what the future will actually hold for them in terms of capital. The level of what's the purchasing, what's the word? Property prices is a good word. I wasn't getting an help. So in any case, because of the height that's and the spike that's coming, apparently they say to us in 2026, there's another property spike coming. I don't know, but the reality is it becomes unaffordable. And therefore, I always say to my clients, I think it's not you that you should be looking at. You should be looking at your kids and your kids' kids, because I believe that it will become unaffordable. So, but because we've got this thing and we are forming part of a developing country strategy, we actually will see many more people that are unable to come out of this poverty thing. So, and that's where I said to the guys, we need to. I believe property is a solution. So I'll just quickly say one sentence on the next slide, if you don't mind, because that we can get. It is possible to become a millionaire family, at least, because 88% of millionaires in the world is self-made and hasn't inherited it. That's an interesting fact. It's a big organization that actually did the research. They've got 82 million trillion under management. That's massive. 12 zeros, by the way. So in their portfolio, 88% of the millionaires is actually self-made. Okay, next slide. The eighth wonder of the world is to understand time value of money. So Buffett and Einstein said compound interest, we know, no? But time value of money is the biggest key to create wealth over generations, if you can apply it correctly. And the answer lies within investments that reproduce returns over long periods of time. That's the key. So you can go to the next slide. The principle of investing is without any seed planted, there can be no harvest. So your seed in the ground is the investment itself. But the key is here at the right-hand side, and it says transforming resources into assets. And when we talk about personal wealth, it is taking your monthly income, that's what's left, and investing it in different forms. That's the key to create wealth. And I think the problem is people actually are not going there. They haven't got money. The middle class, the biggest difference they say between the middle class and the rich is the rich save. The middle class buys on credit. Isn't that true? So the reality is, I mean, if you look at our client base today, we do a before and after budget, and we can clearly see that they're spending, but they get into trouble because of the debt, short-term debt that's in their portfolio, and that's where we assist them a lot. So maybe the next slide. Let me not. So this cycle of poverty, the scarcity of resources is one of the biggest hurdles in our country. Access to clean water, healthcare, and education is three of the biggest issues we've got for the normal average South African to overcome. But we need to realize that there's an answer for it. And I really believe that in South Africa, because it's so easy to fall into this poverty trap on a generational basis, that we need to assist the people to actually get out of it. And I'll show My first case study will just come up now, and I'll show you how you can do that as a family. Just the next slide. I'm just making 4 pillars to break poverty. Quality education, number 1. The second one is very interesting. It's international approaches here. Children involvement in wealth development. You get your children involved, especially if it's generational of nature. Make family investments. We are, for some reason, me and my island. You know, I'm creating this for myself. And then I get the opas who says, I will not leave 1 cent. I will live it out. And I thought, okay, wait, something wrong here. So making family investments, and the reason why he's most likely saying it, because he built it up himself and his father didn't do the right thing. So, and I think the 4th pillar is experience. When the downside that Miguel has just showed us comes, you need to have the knowledge to how to overcome. Most people I know that lose their money at 58, 60 years of age, hasn't got the experience to actually overcome that what is coming to them on a negative manner. So I just wanted to make it click, touch it. Oh, this guy, 50 million rand net asset value, asked all people that he could find, how much is enough? And the answer is when I have money left over after I've paid all my bills. So financial equality is the same for every family. If you earn 20,000 rand a month, 150,000 rand, or 500,000 rand a month, if you've got money left over, you feel good about yourself. In fact, your financial situation is right, you know. So that's what the research has shown from him. So positive cash flow is the key in creating personal wealth. That's it. Doesn't matter on which level you are operating. And I think that's where we need to teach it. But if you are in that poverty trap, it is 100 times more difficult to break out of it. But it is possible, and I hope that's the next slide. Oh, no, it's not. So the short-term survival mentality should be broken and changed to a long-term legacy building one. And I really believe that if we can build a system around a family or a couple of friends, you will be able to break generational poverty. And believe me, the guy that's earning 50,000 rand or 100,000 rand a month, if he hasn't got money left, he feels he's poor. But the irony of it all is he can become poor quickly because he hasn't got that excess and he's not using it to build wealth. So maybe the next slide. Ooh la la. Okay, first case study. How to become a millionaire family. It's very simple. I've got a family of 5. The dad takes 400 rand, mother 300 rand, every child 100 rand. That's 1,000. They invested for 40 years at 12% per annum. After 40 years, there will be 11.8 million rand in that investment. And in today's terms, what's remember what the inflation was I used? 7%, I think. So the 7% inflation, today's terms, 2.3 million. The total cash, Neil, is 480,000 that was put into it. And I mean, who cannot afford, which child cannot afford 100 rand a month? So in other words, it doesn't matter what level of family you are. Every family in South Africa that's economically active, even the lowest, the minimum wage even, can actually invest and turn their family around in 40 years' time. So it's a long term. By the way, if you increase the 1,000 rand by 7% a month, per annum, so in other words, you grow the investment with inflation, it becomes 19 million. But the other figure that's very interesting, that 1,000 rand, the last year that you will be paying it in today's terms will be 61 rand. So you're not even going to feel it. But the reality is just a normal straight savings plan. But now, the next case study, and this is a real case study. The guy said, please don't mention my company's name. So I call them the 3 friends. So how to become a millionaire friends is the slogan here. So what they've done in May 2014, they started each one with 1,000 rand into the kitty. They've invested for 3 years. Initially they were 5 and then 2 fell off, but they invested for 3 years And then in May 2017, they went out and bought the first flat at 280,000. And I think the rent that they got was just below 4,000. They bought the second flat at 310,000, and the rent they got was just over 4,200 gross now. And then they sold both for 450,000 Rand each, which is not a bad investment. I think it was 2018. And then they bought 2 storage units, which they still have today. One for 80,000 and one for 120,000. Both are producing today 2,200 Rand each, gross. So they've got them. In 2021, they got to that stage in their company, the 3 shareholders, and they bought the first flat, 660,000. They bought another flat, around about 800,000 a year later. And if you, in 2023, should balance their company, the net asset value is 1.5 million. So the figures on the left shows you how much money they've put in. Over the almost 10 years, 130,000 Rand cash per individual. Their net asset value is 500,000, as it is, if they stop today. Their return on investment is 24.36% per annum. And if they should have said, listen, let me just start investing my 1,000 Rand a month for almost 10 years into my savings plan with a good return, I would have had 230,000 Rand. So you can clearly see that working together, being involved in property, buying my 2 partners out at one stage in the game is clearly beneficial in terms of return. And remember, they've got property. So I really say, if you want to become millionaires, get the right friends. And invest in property. Okay, in the right way. Next slide. So now I get this phone call, and the guy says to me, listen, you better help me, Gerard. I'm paying 25,000 Rand a month in. I'm short 25,000 Rand a month. He says, what? He says, send me your portfolio. Now, as you can see, there's a longer spreadsheet here, but I'm giving you the short run of it. So he gives me all the properties. So what happened was, in 2021, he signed for all of those properties through an advisor, or I don't know what it's called. But in any case, no, it's maybe not a salesman of property, investors, of investing property. And what he did was, he signed when it was 7.25% in that year. So if you look at Miguel's interest rate, you see it's close, it was 7, just a bit lower in the beginning of that year. So that was nice. He took transfer in 2022, but then the average rate was 9.75. And so he continued, and now he's saying, so all the figures there will say my bond payment, my rental income, then my loss of my deductions that I'm actually paying out, my management fees, etc., etc. So on the top one, you'll see the shortfall is 5,000 Rand a month, just on one. So he's got 5. Ironically, he's taking transfer of another one that he signed last year for, of 950, but now the interest rate is 11.75. So that's another 4,000. That's another 4,400 Rand shortfall. So he's going to be seriously in trouble. And I said to him, you need to do something here. And as I said to the people, he's got another 2 properties in his personal name, which almost gives him 2 million Rand equity. So if he defaults on one, he can actually lose his other property as well, which is not the plan. So we will be able to assist him. So the next slide, part of this case study, I wanted to say financial gearing is a long-term strategy in property investment. If you're using the banks as your partner, play the game. And don't overextend yourself, because the reality is this guy should have bought maybe 2, and made sure, like the few friends, they've saved up 3 years to have a buffer of almost 200,000 to actually stomach the financial gearing that the company will be taking. And this guy did it also in his company, but he overextended himself. There's no doubt. There's no doubt. So just as I would say, remember there at the bottom, a bond agreement is until the day it is paid in full. So it doesn't matter how positive your cash flow becomes until the day the bond is paid. That's when you are not liable anymore and not carrying the risks. So I wanted to show you on the left, you see the red numbers, 279, that's his shortfall for 1 year. And Daniel will get into it. But the green numbers is our product range. You'll be in the green numbers day one. And over a year's time, you would have been in the positive 160,000. So the difference between the two different strategies from a product perspective is 440,000 for 1 year. So
On those 5.
on those 5 only. So my advice would, and even if he goes back and trying to sell every flat, which he will pay in now, there's no doubt there's not enough equity yet, because he bought from a developer who's developing in stages. There's nothing to sell. I mean, he's competing against the bigger player right in his development. So this guy's has got a bit of a trouble. So what I'm just stating here, Neil, on 2031, you know, what will the interest rate be?
Sure. How long is it?
Where? Yes. Yeah, but I'm just saying, you are still playing the game of a long-term investment. And you need to understand, if you look at that slide, I'm going to steal that slide. It is a brilliant slide to show you how interest rate, I mean, I saw now when the World Cup was, it was 8.5%. So that's 5 years. So the guys that bought at between 2010 and 2015 was at 8.5 on average. Look at, there's a slide. Look at that. So those are the ones that we are assisting today. A lot of them bought then, and they couldn't handle it because it went up to 11.75. So that means even on their personal properties, they were overextending. And because of the high capital outlay required, that's why you need a bank. You cannot buy property unless you save 40 years and then go buy a property, which is a different game. But I was just looking at that and I realized, okay, that's how sensitive property is in terms of interest rates.
Yeah, absolutely.
And maybe just a comment on that. You take out 20-year loan, you're going to hit 3, maybe 4
Oh, yes.
interest rate cycles. It's you know, that's what history tells us. So so how do you plan for that?
The answer is you must have enough cash flow. So to take risk off the table in terms of property and financial gearing, you need more cash. So one of the strategies that is followed with the Wealth Assist here is that we're trying to create the cash. All our products is actually, there's different products, but there's certain ones that will create cash so that you can have that buffer when you start gearing. And that's definitely something. So maybe we can just see, I don't know if that's the last slide. Oh, co-investment is a key to build wealth in South Africa. It's been done for many years on a very legal system called the Stokvel. Have you done a Stokvel? Now, it's done big time. 800,000 groups, 50 billion rand is invested together. But there's only one problem with the Stokvel. They don't look long-term. They invest for short-term, for bread or Christmas gifts.
Yeah.
But if a Stokvel can come together for 40 years, they will generationally create the wealth. And I just wanted to mention that co-investing is really an answer, and that's not for now.
Great stuff. Thanks very much, Kara. So I think in South Africa, we've got a scenario, there's a good debt and there's a bad debt scenario. And I think, unfortunately, we look at the stats, they show that most of South African consumers have a lot of bad debt, a lot of short-term credit cards. There's probably too many. It's not uncommon for people to own 3, 4 credit cards at one time. And then on top of that, there's personal loans. So people are trying to borrow themselves out of out of problems. And so that scenario that you said, imagine if that money was cash flow and it wasn't paying bad debt, such as, and property is actually good debt. And that's
That's
for people
very good
because
debt.
you can trade with it.
It can be good.
Well-
You can still trade with it.
But the
And,
thing is, sorry, I just wanted to come in there. You know, many clients ask us, how do you assist a client that's already behind 6 months?
yeah,
Then we look at his portfolio and
Yeah.
we see what you just said.
yeah,
His credit card debt, his loan sharks,
Mm.
that list is so long.
Mm.
And it's the short-term debt that actually kills, and then he starts leaving his bond behind.
Mm.
But if you take out the short-term debt on a monthly basis, he can pay his bond
Yeah.
without any doubt.
Yeah.
And that's where we advise people not to go, but they do.
Okay, Daniel. So you're gonna talk beyond traditional buy-to-let. You're gonna get back into the property model again. So
Great. My part here is dealing with what is the main motivation for investors. We actually look at and found that most investors want to, first of all, leverage for bond finance so that they can actually use their creditworthiness to actually create wealth. But obviously, with it, if you do it right, it can work. If you don't do it right, you always have a challenge. Okay. Enhance their net worth, obviously, is part of that, and develop a portfolio. Most people have got a plan when they want to invest in property that they want to actually invest for a passive income. And that, I would probably say 90% of all people that invest in property that don't do flips want that specifically. Obviously, gearing is a good something to use because you got a bank as a partner at the lowest rate possible, because all other methods of funding will be more expensive. So now the question is, when we started doing, I'm glad Neil spoke about the different years of issues, and you touched on that, Miguel, as well. We sit with a challenge that there was a time when, and I don't know, a lot of you haven't maybe have experienced that, but where the capital growth varied between 15 and 37% per annum. Where we are at the moment at rates which is like totally different with regards to capital growth. We're turning around at about 3.5% per annum. So that's a huge difference. Now, if we look at the stats, and I want us to just quickly touch on the stats, is it still achievable to buy, to let the property and make money? Okay, I'm talking the normal, traditional one. Okay, now if you look at the stats here, you'll see that the average current full title gross yield on the rentals, okay, that means before your deductions of your monthly expenses that you normally would have, like rates and taxes, all those maintenance things, management fees, etc., that would be about 7.25%. Okay, this comes from TPN. For those who know TPN, that's the current national stats. When you look at sectional title, it's slightly higher, but I'll also explain why. It's more because there's not as many there's a higher return on the smaller unit type of thing, but then there's again a bit of expenses that is normally more than with a normal full title, like you have additional levies, things like that, which obviously affects that returns. If we look at then what is the stats on the net yields, okay, on the rentals, and I'm touching now on the capital growth and things like that. This is just your rental income currently, and please understand there's certain areas which far exceeds this kind of stuff, okay? But it doesn't mean it's everywhere, all right? It may be pockets and areas where specifically there's now something or a high demand or something like that. But don't rely on, because he gets it right to get 12% net yield now, that it's going to continue like that in other areas, similar investments and things like that. So we need to take all those things in consideration. So then if we look at here, what is your net yield? Is the 5.8% on full title, 7.3%. your average expenses on a property like that's about 20%. Your average spent here on sectional titles is about 30%, just to give you an idea, if you take everything in consideration. And that will bring me to the next slide. But before we go there, the national capital growth currently on property is 21. This is just the averages, please. So it's not specific for specific zones, specific areas. We can give you all those details as well. What areas are making more on capital growth than other areas. And those are the type of things which you actually can school yourself on, because that will help you to know where to buy at what time. All right. So, but this is about where we are at the moment on capital growth. So if you really want to know, what are you making on your property investment? You just, if you're on full title, you're at 5.8 plus 2% this year. Okay, so we're at 7.8%. Who thinks it's a great return? Nobody. Come on, guys. Don't you think it's good? Okay, so that gives you that. And if you look at that, it will probably give you 9.3% net yield return. Okay. And I actually had a client the other day who sat here and I said, what do you think about 9%? And he said, that's great. Okay. So for some people, it may be great. Okay. Go to the next slide for me, please, Donna. So if we look at this, here's where some of the biggest challenges arise in buy-to-let, and examples of a property of R1 million purchase. Okay. Now, here's the expenses, guys. Look at the percentage that's there at the top. Okay, and I've been nice. There's some agents who will never give you property management for 8%. They'll do it for 10. Okay, that's the averages. Okay, so I'm working on 8%. I say there's a capital growth of 5. What was it that we just saw? 2 in this year, 2.3. Okay, so I've also been nice. Okay, so maintenance. Vacancy and maintenance. Who of you budget for maintenance and vacancy every year? Okay? If you don't budget for it, trust me, it's going to bite you. Okay? So, important is that these things you can't take chances on. You have to pay monthly property insurance. That's an expense. If you don't budget for it, that when the time comes and you've got 10 properties, okay, that becomes a real issue. Okay. If the levy goes up and you've got 5 residential sectional title units and all of their levies are going up because the municipalities' rates are going up, who's carrying those things? Okay. That's important things when you plan to do a buy-to-let and don't want to end up like case study number 2 of Gerard. Okay. Because those things are the things that you must take into consideration. We've worked on a prime minus 5%, 0.5%, okay? We never do a transaction with a real estate investor without budgeting for at least 2% additional exchange. And that didn't even work on 7% because it was 4% more, okay? So things like that is where we have to look and say, okay, let's plan better. All right. Leverage is good. But if we compare now, if currently a buy-to-let is a good investment, we have doubts. Let's be honest. Because is that working? It's not good. It's actually average or lower than that. If we look at what are we building on net worth, 2%. Come on, guys. I don't think it's good. In actual fact, it's less than average, maybe. Okay, I've just been nice. Okay, and the one thing that it still does, though, and that's why I call property investment always good, is that it is good, but it will just take you substantially longer at the current rate to actually do what you have to do. All right. So if we jump to the next slide, I just on that previous one. Look at that figure. That's where Gerard's figure came in. In actual fact, we didn't do our slides together. We sat with it afterwards and realized that we've actually touched on exactly the same problem. And that is that we're sitting here with a 4,000 Rand on R1 million pay in every month. Okay? If you do it well and you buy at 90% and you put some deposit down and pay your own transfer cost, okay? Plus then you have a mortgage of that, and you have all those expenses. Then slightly better. You only have 2,900 to pay it. Okay? So you must have the cash flow. Now, if that interest rate changes to 4% higher, can you actually carry that? That's what you have to test yourself with. Otherwise, you're going to land up in a bad position. Okay? And that's the challenge with normal traditional buy-to-lets at the moment. If this returns, capital growth was currently at 10%, would that be a problem? No. Because after next year, if we go back to the previous slide, just to illustrate that, if this was 10%, okay, we were at 17%. And if we had trouble then, can we sell the property and pay whatever we have to? Yes, no problem. That's what saved people in the past. But they think it still works the same because their dad tells them about how great property is, just buy them and keep them. Okay? Which is not the right answer anymore. Okay. So if we jump to 2 slides further than Tana. Yes. So if we look at the challenges for buy-to-let, buying at the right price, guys, is number one. All right. If you can't buy at the price where the capital of the monthly income brings you to that point that you can actually be cash positive, very close to that, then you've got a problem. Secondly, you must plan your rental income and expenses correctly. We've got a standard sheet that you can use, that you can test every property that you want to buy. And if the yield is not good enough, walk away. Risk management. Calculate the viability and covering the extra cash flow. Should there be expectations? Now, that spreadsheet of ours, very simple. You just add the interest rate. You can up it with 3% and see, can I still afford that? You don't have to guess. It's not that simple, that difficult to work it out. Okay? So those type of things. Tenant selection. Guys, this is probably, I know most of us want to save a lot of money. 8% we want to save on collections. If you manage your properties on your own, you don't know how to do it, it's going to be disastrous. And lots of people burn their fingers because they buy-to-lets and they want to run it themselves. They think it's easy to manage a property rental. It's not that simple. There's specialists for that. So rather use those guys, okay? And make sure, if you don't put the right tenant in, ask for one specific thing when you do this. You ask, you want to verify the client on the end of the day. So let them send you the credit report, okay? Go through the practice. Make sure that you actually do what you have to do. Otherwise, you're going to run short. Maintenance importance. You have to check the property. You have to go and inspect it at regular intervals. Increase rated taxes. There will be increases regularly every year. Okay, so that, first of all, you have to budget. Next year, it's going to go up with 3.5% or 4% or 7% or whatever that may be. If you don't budget for it, you're going to be short. Okay. Then, very important, this thing happens all the time. All those people that comes to Gerard now, that case study number 2, fictitious figures. They tell you you're going to get so much rental, all those type of things. I've done a test for one of my clients because you can come to us if you're one of our clients. We will assist you to make a good decision. So you can just bring the property to us and we'll tell you if it's a good investment in literally 15 minutes. Okay. Because we know and we know what to look for. Simple things here is when there's 50 properties that goes on the market for rental today, guys, just ask yourself, will you get the same rental as the average rental that's already in the area? No. The guy's got 50 choices. Okay, it doesn't make sense. It's supply and demand. It's just how it works. So when you're first year, you have to look at either a rental guarantee that the developer gives you, or if he doesn't give that, then you have to make sure that you budget for that. It's lower income in the first year. All right, things like that. Then don't optimize your every single thing on your credit so that you can actually buy. These numbers are probably, I've got stories like that which will, it's a headline. So stay away from that. Be conservative when you lend money. Okay? Be conservative, plan it properly, and make sure you know what you're doing. Okay.
Daniel, I know you've got a couple of more slides to just take us through. If you can take us through quite quickly, because I tell you what, the time is moving on. And I would like to obviously deal with questions from the audience as well. So can we just quickly maybe just wrap up? And I know this is the
last slide for me, Tana, which I think is more important. This one, yes. Okay, so the bottom line is that what do we do differently? Okay, and I think this is very, very important. As we also do similar products, we call it the recovery products in our product line for it's similar to a buy-to-let, but there's substantial differences. Okay, and I'm just going to touch on them quickly. So if you buy that same property, we never buy higher than 75% of market value, all costs inclusive. Transfer cost, maintenance, whatever it may be. Okay? So first of all, you have a buffer of 25% that protects your returns. All right. So secondly, you look at, we normally propose that you at least pay the transfer and bond costs from your side. Okay? That's what we suggest from your own contribution, just to leverage even lower. All right. Then if we look at what your bond payment's going to be, 10,000 Rand a month, more or less. If you look at your income, now you'll see a few zeros here. There you have monthly rates and levies. There you have monthly property insurance. You have all these things. Here you see the zeros. So that doesn't make sense, no? Okay. We have what we call triple net lease. Okay. So we signed with that client a triple net lease. If the interest rate goes up, the rent goes up. If the property taxes goes up, the rent goes up. Okay? If you've got a buy-to-let, you can't do that. It's your expense as the landlord. But in this case, it will never be. It's the tenant's expense. Okay? So if you look at that, we've done the same amount of investment. That one we run short, 4,000 Rand a month. If we did a good buy-to-let, we are running short about 2.9. And here, we are a cash positive from day one on a monthly basis. Plus, if the interest rates change, if the rates and taxes change, if the maintenance needs to be done, it's all for the tenant's cost. That's the difference, okay? So we've actually just mitigated the risk by transferring that to the tenant. Now, the next best question, which you probably may have, is how will that guy be able to afford it if that happens then? Okay, very simple. For a starter, our average buying price, it's about 60 to 65% of market value currently on our whole portfolio, okay? Which means that if it's R1 million property and we bought it for 600,000 Rand, that rental that's calculated is calculated on 600,000, not on R1 million. Okay, so he actually pays far less than the market value rental. So if we have to go and we have to sell this property on, or whatever the case may be, we are always overprotected in the process because that specific property will then be covered by the rental easily, just by a normal tenant that we put in. Okay, great. I think we're nearly there.
Thanks very much, Daniel. So, I mean, I think what I make out of this whole thing is that you said it right from the start, Miguel, it's all about the numbers, isn't it?
Yeah.
And I just think that to me is what the fundamental story is. Right, so I'd like to invite our audience online. Do we have some questions already? Okay, so we got Anonymous. What grows at 12% per annum for 40 years? It's difficult to find such consistency. Who wants to have a crack at that? Well, you can find that consistency. You just have to walk the streets a lot longer and harder. So, but I don't know if anybody wants to just any comments from any of the panel just on that. I mean,
I think it's always easy to do numbers on an Excel spreadsheet, right? And that's where you get this 12% over 40 years. I mean, but really, sometimes it's 8 and sometimes it's 18. It depends. It depends on the cycles. We saw cycles in the market on the interest rates, and that drives the market. And I think if anything, the concepts you've seen and on the screen tonight illustrate like some key principles about consistency, about sticking with a plan and a strategy for the long term. And if it's not quite 12%, it could be 14, it could be 10, but I think the outcome is still the same with that consistent approach.
Yeah, great. And this is
okay,
an
Neil,
excellent-
if I
wait,
could
wait,
just
go back to-
add something there, just on that. We have got historic returns over the last 10 years that we can give you, that all our private investors signs off. We what we call we sign off on an audit on every transaction, and the average the lowest that we ever offered per year for the last 10 years is 16.5.
Okay, great. All right, the next one is from Nolly McKenna, and he said in the third case study, the investor bought from the developer. And his question is it a bad idea to invest in a new development? Nolly, it is a great idea to invest in a new development if you understand the numbers. And I've got first-hand experience of it. And in fact, my first 20 properties I bought in a new development. In 2001, every single one of those properties doubled. So it was the timing of the market that I managed to get it. I also was the first one of the first few people to buy into that development as well. So there's a combination of timing. So I don't think, I think it's probably it's been portrayed because I represent a lot of developers at stage, and you really, and I think once again, it comes down, any investment comes down to the numbers. So I just wanted to clarify, and that's certainly from my perspective, absolutely. I'm not saying don't do it.
Charlotte has got a very practical example that he actually used one of those examples where the guy's done so well.
Yes.
He's from a new development. So it doesn't mean new development is the problem. I'm just saying be careful for the overselling trap. That's all I'm saying. Because every deal they have to sell is a good deal according to
Please. Sorry, guys. They've taken my mic. Okay, so I just wanted to say to you, if you look at those, the friends, they, how many years did they wait before they buy? They've got $500,000 of cash in the bank, and they've bought one flat at 660 and another one a year later at 880 in a different development, and in another one in a different development now. So what you must realize is that they're very conservative. Together, those three individuals, by the way, is earning not R1 less than 250,000 Rand a month together. They can afford it easily, but they're still that conservative. And that's not what I see with the average investor. Okay.
Yeah. Do you want to just also comment on that, Miguel? I mean, you've probably bought a couple of new developments, I'm sure, in the Sandton area from Johannesburg, and
Happy to. So, I think if you're getting into an area and into development, so from an equity perspective, you cover that, right? You are going to get your return there. I am wary of developments where I'm competing with all the other new stock coming onto the market. So that's where you got to sharpen your pencil and you say, well, what does my product, what does my property, how do I differentiate that from everyone else? And to differentiate on price is the easy way out, and it's not going to actually, and if you drop your price, believe me, your competitors are going to drop their price as well, because now they also have stock. So I think it's about really putting on a business hat and thinking carefully about whether it's a new development, going into an area where there are other developments and other competition, and thinking about how your product and your property will stand out.
Excellent.
Immediately thinking about Joburg, where developments are just popping up like going out of fashion, versus another place that you see a development here and there. So I think that your second scenario there is the better one.
Great. We're just talking about the Bloberg area for the audience over there. I know you couldn't hear what was going on in the background, just the discussion. We've got two more questions here. We've got William van Aarde, and he asked, do you always need to take ownership with the wealth assist method, or can you just invest and get a good return? Well, it looks like you answering that one then, Mr. Lombard.
Yes, you can. We have got different types of products. Some of the products is, for instance, those who know installment sale transaction or ALA, like you know it in the market. We obviously got those opportunities, so you can just put in cash, don't have to mortgage, don't have to take transfer. Then we have got one of our on-sale products, a JV sale, where you have a covering bond over the property, so the person who needs the assistance provides the property, you provide the cash, we sell it on before you actually have to take transfer, but you have a covering bond to cover your actual capital outlay, and your predetermined returns will be built into that.
So the answer is yes and yes and yes.
Yes, yes, and yes.
The next question is a very interesting question, and I think I'm going to actually give you a bit of a crack to answer that one, Miguel. And it's a very interesting one. It's from Anonymous, and it says, I have a very different type of property problem. Big smile. I am debt-free with no bonds, and our commercial portfolio is worth approximately 30 million rand, earning decent monthly rental income, or 400,000 rand per month. That's why, he's anonymous. Otherwise, everybody will be pushing on his number. So Anonymous, we know how you feel. So I feel stuck and feel that we are not growing exponentially with leverage. What would you do in this situation to create a legacy? I think it's a great question.
Very good.
And I mean, being a banker and wearing that banker's hat, I mean,
We don't like this. We don't like to be in that situation, right?
Yeah.
I mean, any investor starting out, any investor kind of well down the road would love to be in this situation. Yeah. Debt-free, income's coming in. This is what it's about. But I love the fact that the investor here, Anonymous, is saying, but I don't want to stop here. I want to keep on. I want to keep on scaling, right? And whether this is a 30 million portfolio, whether it's a 3 million portfolio, I think the principles apply. So, a couple thoughts, and I mean, there isn't a lot to take from there. One is, the strategy that took you here. We tend to get bored with our strategies, and we tend to say, okay, it's time to try something new. I've reached my target, etc. And we forget that those are the strategies that took us there. Assuming things are largely remain the same. So, to change things totally brings a lot of risk, not just into the future growth, but actually to the existing portfolio. That's the first thing I'll say. The second thing is that if this investor wants to take it to the next level, I think it's about, going back to basics, going back to understanding what that next level is about. A 30 million commercial property portfolio is actually not significant. It's relatively entry level in the commercial space. Commercial, bigger numbers, bigger risks. And it's about almost going back to basics, understanding what the markets are, the various markets are, and how to leverage, and rather taking the time to understand what those other strategies would be. Connecting with investors, connecting with those who've gone before. So really, really interesting.
Interesting is
problem. They've got my email now. They can contact me.
Well, he's asked for help. So he says, can you assist me review my portfolio? I'm on a negative cash flow and I will retire soon. So, look, there are many ways to skin a cat, but I don't know if anybody wants to, have a sort of a suggestion. I would say get in touch, and I think that's the easiest.
I think it's
get
easy.
in touch to with Wealth Assist and sit down, and then you can do a review of that. I think there's too little information here to be able to make a calculated kind of decision over here.
And Neil, we often, and some of the other. Today we've spoken about people with problems.
Yeah.
And when you in a stress situation, you got a problem looming up. You tend to narrow your focus, and your creativity tends to narrow as well. You don't actually see the opportunities that when sitting with somebody else, a trusted partner, a trusted friend, they will see opportunities where you don't. Options. Let's say options at least. So definitely, someone like this needs to sit with someone else who's trusted, respected, a bit of experience, and definitely can provide additional options.
Okay, excellent. All right, so what I'm going to do now is, gents, I think we're way over time. I think how many million people do we still have on there? Yeah, okay, good. All right, so I think what we're going to do is we're going to do, first of all, if there's any questions from the audience over here, anybody has a question, if you've got a question, and if you really had a question, what would it be? I'm sure you've got it somewhere, but you're either too scared to ask or you.
Please ask.
Okay, so what I'm going to do then is we're going to break away afterwards, and if you want to ask a question, there afterwards, then we can have some snacks for our live audience over here. So next time when we do this in Cape Town, guys, you must come here. It's fun.
Yeah.
Then we can chat and meet each other and engage. And we want to thank you for coming on this event today. But before we close, I'm just going to go starting with you, Gerard, and then Miguel, and then Daniel. I want you to just give your final parting shots, your thoughts, maybe leave the audience with something that they can take away, that they could take action with. I mean, I really believe that the economy of the world and it's the world. It's not only in South Africa. It's taking a slow turn. There's lots of problems. There's war in Ukraine, and there's in Gaza, Hamas, and Israel, and all that kind of stuff. So yes, there's problems in the world, but there's definitely indicators that the economy is certainly showing progress, and we hope that we can resolve those wars and that kind of stuff. That doesn't break out into a World War III scenario. Then we've got another problem. But I don't think so, and I'm hopeful, and certainly that can be resolved, because that could just destroy world economies, completely. And South Africa's been in a moribund sort of economic situation probably for the last 10, 12 years. And I think it's time, booms come about once every 20 years, and I think it's time for another boom. And I really think if we turn this one, as long as you've got more people that don't have property than actual properties available, it will always be in demand. So our goal is to house a lot of people in this world. So those are just my closing thoughts. But Gerard, would you just like to give your final wrap, your thoughts to the audience out there about?
I would like to just end off by saying that with Wealth Assist, you don't have to invest and save up for 3 years before you can start investing. You can do it initially. You don't have to take the risk of losing it all, like our case study 2 is currently at risk of. There's ways of mitigating that. And when you do co-investment, you actually lower your risk. And remember, you sign an agreement with the bank, and until the day it's paid in full, you are liable. So it is a long-term agreement, and we need to assist our clients every day how to not fall into the pit of losing it. And we're really there for our investors. And please come to us. We'll help you.
Great stuff. Miguel?
I'm going to steal a quote I heard recently. I don't think we should hope for better days when things are stable. I think we should hope to be strong enough and creative enough to deal with those tough days. And I think that's where we are. I think that's where we are. I think at the moment there's an element of stability at the moment at these high interest rates. That's what we actually look for, stability, right? Generally. It's not about the rate necessarily then, which is quite interesting. But we're in a state of turmoil, we're in a state of flux. I think there will always be something going on in the world, in the country. We've got elections coming through around April, May next year. That's going to throw the cats amongst the pigeons in this country. And we can't keep waiting for better days. And I think it's about going out there. It's about gaining the knowledge, finding the right partners, and sharpening your pencil, doing the numbers, and ultimately taking action.
I would like, if you guys could just put that slide on of Miguel with the interest rates, because what he actually showed is very important. We've got all the years that, yes. So if you look at, I think it starts at, what year is it?
2002.
2002 to where we are here, 2023. Whatever you're going to do, property has proven itself over all the years. Okay? They have gone through cycles and cycles. You can go back, I think I've got history from I think it's 69 or 72 up till today, with all the records. And the worst drop ever in property prices was 10%. Average, I'm talking about the average. I'm not talking about specific pockets where the mines close in an area or things like that. So property is always a good investment. So that's my starting point. How you do it, I think, actually is the most important. Okay? And that's where I want to add to what Miguel said, is that there will always be tough times. What are you doing in the tough times? Why are you looking for the opportunities? And if you actually look for opportunities in the tough times, they're actually more. If you do it in a sustainable way so that everybody wins, you'll make good returns. And that, for me, is going from good to great. That's the difference.
Excellent. Great. I think everybody put your hands together for our panel. I want to thank you, audience, and I just want to reach out to everybody there. If you can just pop up a slide of some of the mags and everything, you know, to read Real Estate Investor magazine, because you got to educate yourself, guys. We run a lot of webinars, we run a lot of stuff. You know, build your wealth, you know, think differently. You know, we sit on our phones for too long. We consume the media and we wait for the bad news to come along. You know, don't think of that big TV, you know. I mean, if you've got a TV, throw it out the window, but just make sure it's open because you might destroy your window. So it's very important, I think, to educate yourself. Spend time. There's a newsletter, sign up for that. And, you know, we give you all the latest updates. We've got webinars once a week. In fact, we've got another one tomorrow. We've got another one on Thursday. Go onto our website, click on the upcoming events, and we're educating and we're helping people along the way all the time, like events like these. And we've already had round number 4, and next year we're going to continue with this. And I think we've got a really fantastic panel. You know, having an ex-banker and an investor in the room has been fantastic. So join our community. You know, we have membership. In fact, it's Black Friday coming up on this Friday, guys. You know, get out those credit cards and spend. But rather take a 99 Rand per month package.
with earning a lot of knowledge.
Yeah, absolutely. Invest in your knowledge, and that's where we get a sort of a starter pack which will get you going. And there's a whole lot of things that you get, a whole lot of benefits. But I'm just trying to get you into this thing about educating yourself continuously. I think there's one more slide. Is there another one for Friday? Because remember, Thursday is Thanksgiving Day. And a lot of people don't realize that that's just one of our events. And we also do a number of live events. And that's Istiani from Lightstone. You can carry on with the next one. And in fact, I actually welcome everybody to join our residential. It's actually our Reside Summit, which is actually in Johannesburg on the 10th and the 11th of July. And it's going to be a monster. It's going to be next year. And there is a couple of others that are going to happen. We're waiting specifically after the election because we're hoping that things are going to be better, and they are going to be better. And because we're in this fixing mode, and we have to, I think, you know, we have to be the solution. And that's what I like about our discussion today, that we're trying to be the solution. And we're trying to get you to also be the solution. So once again, to Daniel of Wealth Assist, and to Gerard of Wealth Assist, and of course to Miguel, our ex-banker and investor, be very successful. Thank you all very much. It's been a wonderful day. And to all of you, thank you for joining us, and successful investing to you. We see you next time at our next webinar. This is Neil Peterson, along with the Wealth Assist team and our guest, signing off. Thank you all for joining us, everybody. Thank you.